Hello, everyone. Thank you for joining me today. My name is Kim. I am a financial wellness coach here at the New Hampshire Federal Credit Union Centers for Finance and Education. Today, we are going to be talking about different types of mortgages, and there's quite a bit. um, and so, we are just going to touch base on the surface of these different types of mortgages and kind of give you a little insight of what they are, what you need to look at. And then, that way you have a little bit more education. That way, when you're ready to go in and purchase a home, you're getting, that there is more than just one type of mortgage. And you're able to sit with the lender and talk to them and ask the right questions and see which one's going to be right for you. Okay. Also, in this presentation, there's a couple of websites that I went to that I enjoyed, that I got a good portion of the information from. I actually put those links in the presentation itself. And so during this webinar, if you go to the control panel, there's going to be a couple of different things you can do in the control panel. If you go to the control panel and you go under questions, at any time, go ahead and ask your question if you have one. Go ahead, type it in, and that question will come to us, but it will come to us via email. And what we will be doing is we will be sending up a follow-up email to you guys with any questions that were asked, including the answers. And we keep everybody anonymous, so you don't have to worry about us using your name. You don't have to worry about us or you interrupting the webinar. Even though we love questions throughout the webinar, we realized that a lot of people weren't asking them because they didn't want to interrupt us, which I appreciate greatly. You guys are wonderful. But we never minded, never. So we figured we'd do it this way as well. You will automatically get an email after the presentation with the video recording. But one thing I want you guys to do is when you go into that control panel, you're going to see where it says questions. So that's where you can ask your questions. You're also going to see a spot that says handouts. That is where I'm going to put the PDF file of this presentation. And with that PDF file, you're going to be able to click on the links on all the pages and go to that particular spot and get that information. And there's also a short video at the end that I have from Bankrate. So I just want to make sure that you go to the handouts area and you download that PDF. That way you will have that. That way you will be able to take advantage of those links. Okay? All right, perfect. So let's go ahead and start. Again, if you come up with any questions, ask them. We won't be touching base on them during the webinar, but we will be able to, we'll send out that follow-up email with everything for you. Okay? So just want to, again, welcome you guys. The Centers for Finance and Education, we love to bring education and coaching to individuals, families. We want to help implement proper tools so you guys can reach your financial goals, and that's just like with this presentation itself, with the types of mortgages. A lot of people don't realize how many there are, and they trust that the mortgage lender is going to address everything, but that's not always the case. So it's good to have this little tidbit to know there's more than just one or two products, and to go in and say, okay, this is where I am. This is what I'm looking for. What's going to be the best fit for me? Okay. And with these links, you can do more research. So that's why I really want you guys to take advantage of that PDF under the handouts. Okay? All right, so we're going to be talking about main types of mortgages. So this is just an overview. So we have conventional, jumbo, government insured loans. And you'll see a lot of people are familiar with the FHA. They've seen that before. Not as familiar with the USDA, but familiar with the VA loans as well. Okay. And within those loans, you can have fixed rate or you can have variable rate. So we'll talk about those. And then there's even some variations of those as well. We're not going to dive deep into any specific mortgage because we have listeners that are from all walks of life that one loan might not pertain to them, but the other one might. So I don't want to take too much time on one loan versus the other. Okay, so we're just going to touch base. That way we can get, I'm going to go into each one, but not into the nitty itty bitty gritty. Okay. All right. So these are the things that we're going to be talking today. So first we have the conventional loan. And I know a lot of people that come to our webinars are Dave Ramsey fans. Dave Ramsey will always tell you to go with a conventional loan. He's always said that it's the cheapest way to go and to do it that way. And so a lot of people just focus in on, well, that's what Dave Ramsey said, that's what I'm doing. Which, I mean, if you love Dave Ramsey and you want to follow him to a T, by all means, go for it. But what actually is a conventional loan? If you've listened to some of Dave Ramsey's stuff, he goes into it a little bit, and he's really good at explaining it. But so what a conventional mortgage loan is it's a conforming loan, which simply means that it meets the requirements for Fannie Mae and Freddie Mac. So both Fannie Mae and Freddie Mac are government-sponsored enterprises that purchase mortgages from lenders and then sell them to investors. So I know that's, and you guys might have, if you do have a conventional loan, this happens like when we got our loan, within a month it was already purchased and moved and gone, and we were with a new lender within a month. We didn't even make our first mortgage payment yet before it was at a new lender. Okay. So what this does is it frees up the lender's funds so they can get more qualified buyers into homes. So if we take a loan out with company A, and then they're able to then sell that mortgage to Fannie Mae, Freddie Mac, then they get the money back from there. And so now they can lend out again. And so this is what really frees them up to let more people purchase homes. Okay. So, and then a jumbo loan kind of falls into this, but it's like a non-conforming mortgage, which we'll get into right after we talk about conventional loans. But they kind of go hand in hand. The only difference between them, really, well, one of the big differences is the amount you're purchasing your home for. So, with a conventional loan, there are several different sets of guidelines that fall under the umbrella of conventional loan. So there's no single set of requirements because each lender is a little bit different with how they do the process. But they do have some stricter credit requirements, and this is why they usually have the better interest rates, is because they're a little bit stricter when it comes to credit. Okay, and you're gonna see down here where I have Rocket Mortgage. on the PDF, it's going to be the same thing. It's going to look the same, but it's going to have the link that you'll be able to follow. Okay. So a down payment for a conventional loan can be anywhere between 3% for new home buyers to 5% if you're not a first-time home buyer, 10% if it's a second home, and can go all the way up to 15% if it's a multifamily home. So what a down payment is this when you're purchasing a home, this is how much you're putting down when you purchase. Okay. And then these are some of the other requirements. So there is what we call PMI. You might have heard of that. So with the conventional loan, you have private mortgage insurance. If you put down less than 20% on a loan, you will be required to pay for private mortgage insurance. What this is it's insurance that covers the bank. It doesn't cover you. This is not your homeowner's insurance. This is something that helps protect the bank if for some reason you can no longer pay your mortgage. Okay. And with a private mortgage insurance, it's usually if you don't put down the 20%. So, but what's great about this is once you hit 20% equity in your home, so after paying for, a year or two, depending on how much you put down in the beginning, it may just take a couple years, may take 3, may take 5. But once you get to that 20%, you some lenders will have it automatically drop off. I always recommend reaching out to the company that holds your mortgage to let them know, and then they can reassess, and then they can take that PMI off. Okay, so that's the exciting thing about PMI, because when we start talking about other loans, there's going to be some other type of fees, some other type of insurances that are very similar to this, but they stay a lot longer. Okay, so credit score for conventional loans. So with these, you typically need a score of at least 620 to qualify. Now, if you've seen our other presentation regarding your credit and getting it home buying worthy, it's a full hour of talking about having the best score you possibly can by the time you're ready to buy a home. Because the higher your score, the better rate. And because homes are such large purchases, it makes a gigantic difference. And I was doing some calculations with people, and I was showing them that you could save hundreds of thousands of dollars depending on your score. Okay. So even though it says you qualify with at least 620, let's try and get it up as far as we can. Okay. Debt to income ratio. Most conventional loans, your DTI, so DTI is debt to income, must be 50% or lower. And you'll see with some of these other loan types that it's even stricter than the 50%. And when we talk about DTI, you can actually calculate this yourself, which is great. So you can have an idea where you are. Most lenders like it at 43 or lower. But what you do is you take your income, your monthly income, and it's your net, not your gross. And you figure out how much you're paying on debt each month, and it's minimum payments. So if you have credit cards, it's minimum payments. This is everything that's reporting on your credit report. So you have car loans, personal loans, credit cards, student loans, all those good things. And you add up all that monthly payments for the debt, and then you divide it by your income. And that's where you get that debt to income ratio. You divide debt by the income. Okay. And that will give you an idea. So that will let you know, oh my God, I need to work on this, or oh, I'm in a really good spot. I'm doing good. Okay. Next for a conventional loan is the loan size. So for conventional loans, they have to fall within the loan limits set by Fannie Mae and Freddie Mac. Reason being is because they purchase the loans from the lender. So they need to make sure that they fit within their limits to be able to purchase those. Okay. The loan limit actually does change annually. So this is something that you want to look into. But for instance, so when you're looking, conforming loan limits vary by state. You can borrow up to 700, and just like it says here, 726,200 for a single family unit. But these loan limits can actually increase all the way up to a little under a million, 1.1 million. And the reason for this is just because, like I guess in Alaska and Hawaii, it's just higher cost areas. And so because of the higher cost areas, they wanted to make sure that people were able to get the conventional loan. And you can actually, by going to, we'll see in the next slide when we talk about the jumbo loans. When you go to specifically look at the jumbo loans, there's going to be a link. When you use the link I provided, you go to that page, there'll actually be a link that says conforming loan limits. So you can actually see, what you can qualify for county to county. Okay. Yeah, they'll have a whole map, and so it's really cool. But that's primarily the conventional loan. And what's great about the conventional loan is a lot of these other loans have stipulations associated with them. And so what happens is if you're in a market that was crazy, like what we had in 2021, 22, is if you had anything other than a conventional loan or a jumbo loan, it was very hard to have. If you put in an offer, it was very hard for it to go through. The reason for this is because with the next loans we're going to be talking about after the jumbo loan, they're government insured. So, anything that's insured by the government usually has more stipulations. And because of those other stipulations, because it was a seller's market at that time, they didn't want to deal with all of those stipulations. We ended up buying a house at the end of 2022. And if we had one of these other loans, we wouldn't have been able to get it without the seller fixing up some stuff because of certain requirements. And so mostly in the seller's market in 21, 22, sellers were only looking at people with typically conventional loans or paying in cash. So it was very tough. And so that's why kind of understanding, what these loans do, stipulations, it can be very helpful depending on the market. So next we have the jumbo loans. And like I said, the jumbo loans are like conventional loans on steroids. Okay. So we were saying how the conventional loans has the conforming loan limit. Okay. Well, that's where that question of, well, if I want to buy a house higher than that, what would I do? This is what you do. You do a jumbo loan. At least if you want to stay with the conventional. So what this helps with, helps if you want to own a home in a very expensive housing market, you can, okay? Because these are for, you can get a jumbo loan for like the $2.5 million homes. I will never be able to have a jumbo loan. So, yeah, it's just wishful thinking. But with these, they actually tend to have higher interest rates. They do have a little bit more restrictions than a conventional. Okay. So they have stricter requirements than the other actual mortgages. And you'll have to meet very specific property type, their specific down payments, credit score, debt to income ratio. So they are just more restricted. And it makes sense, right? Because it's a lot more money. So when you go to this link, if it's something that you're thinking about doing, then you can go to this link and it'll bring you up to a page that talks all about the jumbo loans. It goes into depth about the property types, and then you can even, they'll have links within that paragraph to go look at things that you're interested in. So you can actually use most jumbo loans talking about property types. You can use most jumbo loans for primary residence, vacation homes, investment properties, things like that. You'll notice the mortgage you've talked about next, you actually can't do that. So that's nice. Down payment. So for jumbo loans for single family unit, they will, some places, and again, this all depends on the company, but it's common to see lenders require 20% down. Okay. For a multifamily, so like let's say a 2-family or a duplex, sometimes they'll require 15% down. So you can just imagine that these jumbo loans are for bigger mortgages, but you have to have a bigger down payment. Okay, so it's amazing how much money to put. I'm like, think about if you're buying let's say a $2.5 million home. All right, so we're doing the 2.5 million, and let's say we have to put down the 20%. That is 500,000. So they would have to put a down payment of more than what my house was even close to being sold for. That just makes you sick. Anywho, but I mean, people work very hard to be able to afford those type of homes. God bless them. I mean, I work hard, but yeah, not going to be able to do it. Anywho, so for credit score, so we were talking for conventional, typically 620. With a jumbo loan, you're looking at least a 680. And that makes sense, right? And some may even require 760, depending on the property type, which makes sense. These loans are very, very big, a lot of money. And so you want to make sure that you have a tip-top borrower to be able to take out all this money. So that makes sense. And that's typically if they're taking out a 30-year loan. Okay. And again, with the debt to income ratio, I think with the jumbo loans, they're more restrictive than the conventional loans. I believe they are, depending on the lender, I believe they are 45% or lower. Which again makes sense because you're taking on a huge chunk of change. But yeah, so that's jumbo loans. Next, we're going to go ahead and, again, this link goes right to the jumbo loan page. Next, we're going to be talking about the government insured loans. Okay, these are the ones that I think more people are familiar with, or at least two of them. The FHA, which is Federal Housing Administration. It's backed by the Federal Housing Administration, so that's why they call it the FHA loan. All right, so this is an agency that's actually under the Department of Housing and Urban Development. You might have heard people say HUD. So it's under them. So, and what FHA loans really, what it really means is that the owners of the mortgage are protected against loss if you default on the loan. Okay, so they're backed by the government. These loans are typically more attractive to first-time home buyers. And the reason being is the restrictions or the requirements are a little bit less. And this is also the reasons why sellers in the seller's market weren't looking at people who had government insured loans, is because they didn't have, because the sellers also have to meet minimum property standards. And anyone who was looking through the height of this last seller's market knows that the houses were disgusting, at least in a certain price range. If you were looking at homes that were in southern New Hampshire around 350,000, they were fixer uppers. We went to so many homes that there was holes in the walls. We had one that had floors ripped up, cabinets hanging off. Like, it was amazing what these houses were going for, and they were like, we had our son at the time, that when we were looking, he was almost 1. He was crawling, and I wouldn't dare put him down on some of these floors. That's how bad these homes were. And we were looking at $350,000 homes. It was gross. So that's why a lot of the sellers, because it was such a hot market, 21, 22, that they didn't need to do anything, especially if they're looking at cash offers and conventional loans, because there's not as many restrictions. Okay, so, and with the FHA loan, you can see that credit score requirements are typically lower than other loans. You can accept a lower down payment. You can, so, and this is a big one, that you can still qualify for a FHA loan if you've had a bankruptcy or other financial issues in your history. And closing costs can often be rolled into your loan, so you don't have to save for them. And then there's, even if you talk with like New Hampshire Housing, sometimes they can even get those so you don't have any closing costs or anything like that. So it's really nice. So some of the requirements for FHA is when the home you are considering must be appraised by a FHA approved appraiser. So it can't just be any appraiser. It needs to be an FHA approved appraiser. Okay. And also, this has to be a primary residence. It cannot be an investment property or a second home. Okay. And the other stipulation that goes along with that is you actually must occupy the property within 60 days of closing. This is another reason why FHAs were overlooked is an inspection must occur. And that inspection must report whether minimum property standards are met. Remember how I said that the seller had to meet these standards? Well, in the crazy sellers market, people they were dropping their inspections. They weren't doing inspections, and you can't do that with an FHA loan, right? You have to have an inspection. So that's why I mean the sellers, if they can get away with selling their house without having an inspection, then they're golden, because if anything happens or if there was anything going on, the buyer's not going to know unless they're in the business. And so they much rather go with somebody who's just purchasing the home. Nope, we don't want inspections. We don't want to look. We're fine. If something comes up, we can take care of it. Okay, so that's another reason why they're not too keen on the sellers when it's a seller's market. Now, when it's a buyer's market, whole different ballgame. Okay. Now, with an FHA loan, usually the minimum payment typically is about 3.5% down for a credit score of 580 or higher. See how we said that the requirements are kind of lower for this? But if you're making a 10% down payment, your credit score can be actually between 500 and 579, but in that range. Okay. But that's just a general rule. Each mortgage company may have their own process and may have their own rules, so don't expect that for every place every place. It's going to be different, slightly different in their requirements when it comes to that. Okay. So we talked about conventional loans having the PMI, private mortgage insurance. Well, FHAs have what we call MIP, mortgage insurance premium. Okay, you might say, well, isn't that the same thing? No. So unfortunately, the great thing about the PMI is that once you hit 20%, you can get it off your loan. With the MIP, that mortgage insurance is for the life of the FHA loan. Okay. The only time that may differ is if you put at least a 10% down payment down, which may result in your MIP being dropped after the 11th year. Okay. So that's where it differs when it comes to that type of insurance. Okay. So, also with that mortgage insurance premium, it's actually based on, I think it's actually based on percentage of your base loan amount, and that's how they come up with that figure for that. With the PMI, they used to have a set amount, but they actually go by credit score now. So for instance, like if I bought my house 10 years ago or 15 years ago, PMI was kind of at a set amount of like $240. But but now it's actually based on your credit score. We had extremely great credit scores, and our PMI, we put 10% down, our PMI was $20 a month. So not bad, not bad. Okay. Debt to income ratio. With this one, it's actually not at a set amount, depending on where you go. It can actually depend on your credit score as well. So the higher the score that you have, the higher debt to income ratio you could have going into purchasing the house. But with their particular stipulations, they really don't want to see a debt to income ratio exceeding 43% for the FHA loan. Okay. And just like with the conventional loans, there's actually a maximum limit to what you can borrow for an FHA loan, depending on the county that the home's in. So if you're thinking about the FHA loan, definitely go to the link at the bottom of the page, and it'll bring you to, you'll scroll down, I believe it's probably about halfway down the article, where you'll see there it's going to be bolded. It says FHA loan limit, and within there it's going to have a link to go to the mortgage limit page, so you can see where you're looking to purchase and see what the limits are for that area. Okay. Also with interest rates, they can be very competitive with the conventional mortgage. Just because it's government backing allows lenders to offer you a lower rate. So that's good. But again, with all these loans, you still are going to have to provide income statements and all that good stuff, because they need to make sure that, there's going to be some, depending on what they're looking for, they'll have, W-2s or and possibly other things depending on what they're looking for in all income sources. Okay. So next we're going to talk about that USDA. So this is United States Department of Agriculture. Okay. So what this loan does is these are loans that are issued for qualifying low income borrowers and with really low interest rates. So this really helps people that may not be able to afford a home otherwise get into a home. Okay. So USDA loan guarantees. These loans are issued by participating lenders and offer low interest rates and minimum down payments. So these are the different types of loans you have under the USDA. And then you also have a USDA home improvement loan. These loans are given to qualified homeowners to make repairs or improvements to their homes. Okay. So those are some of the types of USDA loans. Not every place has these, so you'd want to check and see if you're interested in one of these USDA loans. Then you definitely have to check the company. So what with the USD eligibility requirements, this is usually when people are looking to buy a single family home, and it's kind of in the rural areas as well. So the location, it must be in an eligible rural area. Again, if you use the link, it'll bring you to the page where if you look under the heading of location, it will show you eligible sites. Okay, so that's one particular requirement, is the location and where that's found. So income with the USDA loans are for families who demonstrate economic need. So again, they're specific income requirements when doing this loan. So you can actually, when you use that link to check property eligibility, you can actually, I believe that they also have income eligibility in the same area. So they'll probably have a link for that. So you can always check to see if that's going to be something that's going to be beneficial for you. Okay. Especially depending on where you're planning on purchasing a home. This one also has a right with the debt to income ratio, typically recommended under 43%, under 43% or lower. Okay. With the credit score, this one is typically 640 or better with the credit score. Okay. So again, these are typically for low income families and for purchasing a home in a rural area. Now, with the other loans, with the PMI, the MIP, this one doesn't have any of those, but they call it a guarantee fee. Okay, they do have that. And what that is it's an upfront and annual guarantee fee, which is similar to the mortgage insurance. And it actually goes toward funding the USDA loan program. So this annual fee is added to your monthly payment and lasts for the life of the loan. Okay. So again, it will be there and it's going to be there. Okay, so that's one difference. Appraisal. USDA loans require an appraisal by an independent third party before approving the loan. So this is something that even the conventional loans have to be appraised, but like this one, it's an independent third party, whereas the FHA, you had to have a specific FHA appraiser. Okay. So yeah, and with the USDA, again, just like the FHA, it actually has to, the condition of the home has to meet certain USD standards. Okay, so they'll take that into consideration, because last thing they want to do is help a low income family get into a home and then all of a sudden have it be completely a mess, and that doesn't help anyone if you get into that. Okay. Next, we're going to talk about VA loans. So VA loans, you're going to see that most people have heard of VA loans. And so with VA loans, it's actually Veterans Affairs. It's backed by the federal government. And so there's actually a few different types of VA loans. Kind of like how there's, they have a purchase loan, a VA renovation loan, Native American direct loan, VA cash out refinance. There's a bunch of different VA loans. So if you are, so who qualifies for a VA loan? We'll start with that, right? So active duty, National Guard or Reserve Service member, or a veteran who meets certain minimum length of service requirements, a surviving spouse of a military service member who passed while on active duty, or an active duty military member or veteran with a disability connected to their service. Okay, so first off, that's who's eligible. With this, though, you also have to have a certification of eligibility, and you'll need to complete that. And that's just verifying your status as a qualifying service member or surviving spouse. You can get that form. I believe I think on the, if you go to the link and it brings you to the actual article, I believe there's a link to the loan eligibility for you right there. Okay. But with these loans, if you qualify, they can be really good. Okay, so no down payment. So when you buy a home with a VA loan, you're able to finance 100% of the home's purchase price as long as the individual lender is agreeable. So again, I've talked about how there are certain restrictions depending on the mortgage lender. This is the same. So this way you won't have to worry about saving for a down payment because that can be expensive. But again, it also depends on the market as well and what the sellers are willing to look at and willing to accept. No mortgage insurance, so you don't have to have the mortgage insurance itself, but they do have a what they call a VA funding fee. Okay, so they like to throw something in there. If it's not insurance, it's a fee. But this one is a flat fee. It's set by the federal government. It's 1.4% to 3.6% of the loan amount for the purchase loans. And you can pay the VA funding fee upfront or actually incorporate it into your total loan amount. Okay. And depending on your down payment amount. So even though it says you don't have to do a down payment, it's always good to do something because then you will already start with equity in your home. Okay. Again, no mortgage insurance. We have that fee instead. VA loan limits. So we've been talking about limits like the other loans itself. And with the VA, they aren't based on which type of VA loan you select as a borrower. They're actually determined by how big of a mortgage an individual lender is willing to extend. Okay, so VA loan limits may be impacted by your income, credit score, and debt to income and other factors. So there are those loan limits that depend on what you're going for, which can be a good thing, can be a bad thing. But, I always find that limits are there for a reason. And if you don't qualify for a certain limit, then you shouldn't be going for it, right? Because if you don't qualify, there's a reason why you don't qualify. And I always tell people, and even sometimes the ones that you do qualify for, sometimes are so ridiculously out there. I know when I was first just toying with the idea of purchasing a home, and I went into a mortgage lender, showed them my income, my debt, and they ran the numbers. They said I could afford a $300,000 home by myself. At that point, I was making $40,000 a year. No, I wasn't even making that. So yeah, I was like dumbfounded. I'm like, I can't afford that by myself. Are you crazy? So I always think limits are there for a reason and are good. Okay. But with VA loans, it's also easier requirements. So lenders tend to offer more flexibility when it comes to credit score. Financial requirements for VA loans than most mortgage options. Qualifying service members may find it easier to be approved for a VA loan than other mortgage types as well. So, and I mean, if you are have this available to you, it definitely, especially depending on the rates and what they're looking at, it's definitely worth looking into and applying, and because they have these programs for you, and it never hurts in looking and seeing what you qualify for as far as the mortgage type. Again, we have the link right here, so if that's something that you're interested in, what it will do is it will actually bring you to the government insured loan page. It will have all three of these little guys in there, but then you can actually go into each specific loan type and actually learn more in depth about each one. So for instance, like the VA loans, if you go to this page and then you go to VA loans, it's like a black hole of information. And they will talk to you about the different types of loans that you have available for you, eligibilities and things like that, property types, income, and down. It just goes into all these different types of information for you. So it's a really good avenue for you to kind of dig deeper and see, and be able to get your knowledge on that. Next, we have fixed and variable rates. So it's pretty self-explanatory. So we have ARMs, like, of course we have ARMs. No, what I mean is the variable rates, they're typically called ARMs, so adjustable rate mortgages. Okay. They're typically 30-year loans. And what these are is it's, excuse me, the most popular adjustable rate mortgage is the 5/6 ARM, which has been replaced with the 5/1 ARM. What that means is that 5 in the front, that means you have the introductory rate, whatever that might be at the time that you're purchasing your home, lasts for 5 years. Okay? That's the 5. After that, the interest rate can change every 6 months. That's what the 6 stands for in the 5/4/6, or every year, which is the 5/4/1. Okay. And so this is very enticing for people when it comes to the loans, because when they have the adjustable rate, usually the rate in the first 5 years is lower than the fixed rate mortgages. And then, because they're hoping by the time you get to where that introductory rate stops and the interest changes, that we're hopefully at a higher interest rate. So this type of rate, so the rate mortgage, the adjustable rate mortgages, it's good for people who might be planning on just staying in their home for 5 years and then picking up and going. And so it's very I'm trying to figure out the word, that enticing to do the adjustable rate mortgage. The con, of course, is if you do place your mortgage rate, when you look at your availability, your financial availability, and you place it on that introductory rate, whatever happens in government that might cause, or the economy that may cause interest rates to rise, all of a sudden when you get past that 5-year mark, your interest may skyrocket, okay? And then the home that you were in that was affordable for the last 5 years is no longer affordable. Okay, so that's a downfall of the adjustable rate mortgage. Fixed rate mortgage, this tends to be the more popular type of financing because it's most predictable, right? You have your fixed rate. It is what it is. Your monthly payment tends to be the same, but there are some factors that can depend and can actually make your payment fluctuate. And that's if you escrow your taxes and home insurance into your mortgage. If your taxes go up, if your homeowner's insurance fluctuates, that can cause your mortgage payment to fluctuate as well. But it's not due to interest rates, it's due to taxes and home insurance. Whereas with the adjustable rate mortgage, not only are you dealing with the fluctuation of interest, you're dealing with the fluctuation of taxes and home insurance. So you have all three that you're contending with. Okay. So those are the type, and like with conventional, you can have fixed rate, you can have the adjustable rate mortgage, and same with the other guy. So it's kind of a subset of the other mortgages. Okay. So this is going to be the video types of mortgages. This is from Bankrate. So it's going to talk about conventional, jumbo, government, fixed rate, and adjustable rate, kind of what we talked about here. It's going to be a joint. He touches on a couple of different things that I didn't touch on. And I believe it's about 11 minutes. So I watched it and it's really good information too, in addition to what we provided here. Okay. And so again, if you guys have any questions, go ahead, type them in now. We'll get that follow-up email to you within the next 24 hours. All right. And here's our information again. When you want to go ahead to take out that handout and download that handout, and that way you have our information. Okay. So I just wanted to say thank you so much, guys, for taking the time to be here with me today. And I hope you all have a wonderful day. And thank you again. And if you need anything, reach out at any time. We'd be glad to answer any questions that you have. All right. Thank you so much and have yourself a good one. Bye now.